the hour. She said there's a massive disconnect in equities. I think some people would say there might be a disconnect in some of the data we're seeing. Well, Tom, in some of the incoming information, some of the things we're hearing from companies.
You've got to stay with us for at least the next 15 minutes because the woman that's coming up here says something isn't right, and that's going to be the theme. And we know, John, in the equity market, you go to bonds to find what's going on. Lisa, what is going on with curve inversion now a full negative 84 basis points? I mentioned the 3-month 30-year is out to truly 30-year inversion.
The bond market believes the Fed is going to raise rates beyond 5%, that 5.1% average. That is the takeaway. They believe the Fed. What they are perhaps also believing, and this is where it does go in tandem with equities, that it's going to be immaculate disinflation. I mean, I keep going back to that you're going to get inflation coming down without the pain that Jay Powell talked about at Jackson Hole. And that's the disconnect in markets. Can you get inflation coming down to the Fed's goal without that pain, without a recession, without a material uptick in employment and in wages?
John, in Germany, immaculate disinflation.
Yeah, you want to call
very
it that?
Immaculate.
When you move from 10 to 9, is that disinflation? Tom, going from 10 to 9?
I think it's
some people would say
nuanced.
that's disinflation. The Germans would say it's a problem.
Yeah.
I would take the point we're all waiting for February 14th for different reasons. There will be the acquisition of roses by Mr. Farrow. Mayor Adams called me.
Usually you get complaints from me about the cost of roses.
We do.
I don't think we're expecting any. Are we expecting any disinflation?
No, I don't think we'll see an immaculate disinflation.
You'll tell us.
On roses.
Do you want my rant now or next week?
No, we'll take it now.
No, we'll take it next week. He's just pounding the table.
Ready to go.
What are you buying?
I haven't gotten there yet. I have people sending me stuff. I actually have retail people
send you Valentine's gifts.
I love it.
I like
I don't know
I've
how
already
to get
gotten the flowers.
What an absolute stud. You know, what are you getting? He just lays back, sitting there with his Tang and says, people send me stuff.
No, they're sending me photos. They somehow
does
get
Mrs.
my
Keene know
email.
that?
And Mrs. Keene has them sending me photos of stuff.
Right. What?
And I'm just shocked when I see them.
But I don't want to go there. Futures on the S&P.
Let's save ourselves with the data
by
check.
0.7%. People send you photos. Okay. In the bond market, yields look like this. Claims 26 minutes away. Your yield on a 10-year down 2 basis points, 358.80. TK.
It's interesting here, and I'm going to go to the 2-year yield, John, 4.43%. I got curve inversion, negative 84 beeps. There's something going on here.
Something is going on, but Tom, look how much has changed already. 2-year right now, 442. To close the year last year, 442. So we have round-tripped on a 2-year yield, Tom, and a 10-year. I think a 10-year is something like 30 basis points off the low of the year, which was back in January.
Let's talk to someone in the trenches here of what do you do given the jumble, and I love what Victoria Fernandez and Crossmark Global says. They just simply say something isn't right. That's dead on, Victoria. What isn't right?
Yeah, I wish I knew, Tom. I wish I could lay it out that simply, but we just don't know. You're looking at this data and you're saying the puzzle pieces are not fitting together, because if you tell me we're going to have inflation of 5 to 6% with the S&P valuations of 18 times or a little over 18 times, that I've got the Federal Reserve and central banks globally saying we're going to continue to hike rates. You've got an inverted yield curve. I like to look at the 3 months to 10-year. That's 110 basis points inverted. And you've got money growth, M2 money growth, falling at almost 4% annually for the last 3 months. You look at all that and say, oh, no problem, the economy's in great shape. And I just don't believe you on that. But you can come and tell me consumer balance sheets are good. Corporations are cutting costs in order to help their margins. The labor market is super strong. And let's look at credit. I mean, with Lisa there, we can talk a little bit more about credit. We see $160 billion of issuance in the U.S. in the month of January, and credit spreads are tighter. So that tells us that maybe we aren't going into recession. So tell me how you fit all these things together. We aren't really finding a solution right now, which means more uncertainty, more volatility, and for us, that means you have to be very cautious with your portfolios.
You're in the same camp as Lisa Shallard at Morgan Stanley, it seems, 24 hours ago, who said almost exactly the same thing, said there was a massive disconnect in equities, went on to say history is not kind to these kinds of massive disconnects. Do you think there's a bigger disconnect in equities or credit?
Well, I think the credit market is coming around. Lisa just mentioned a moment ago that the bond market is actually believing the Fed, and I think that's somewhat new. Let's look back a couple weeks ago when we saw yields drop pretty dramatically here in the U.S. And interesting enough, global yields did not follow U.S. yields lower. And it's like the U.S. market was saying they didn't believe the Fed, but they started to come around after Powell's speech this week. So I think maybe the larger disconnect right now might be in the equity market. A lot of the technicals are saying this is more of a sustainable rally than what some people believe, but we have to be careful because, look, yes, we had a golden cross, but historically there's a tremendous amount of volatility and whipsaw movement around a golden cross. We're seeing more and more equities trade above their 20-day moving averages. But again, you have to look at the trend lines, and right now they're still down. So I think that's where we see more disconnect. I just want to be cautious. I don't want to buy into something that turns into a bubble. I would rather be a little bit late to the party and be more sure of what we're seeing.
Although the question around being conservative has been a serious one over the past 12 months because some of the more conservative instruments have seen some of the worst losses going back decades. David Lebovitz of JP Morgan was on just moments ago, and he was talking about holding a greater amount of cash in his portfolio than before the pandemic. Are you in the same camp?
So you always like to hear people say cash is king, right? But for us, we feel like you need to be invested. You need to have a balanced portfolio so you can be tactical and take advantage of the moves you're seeing. So have you added some fixed income? I hope you did. I hope you added it last year like we did. We extended duration in our portfolios. Once we hit that 4%, 4.25% on the U.S. 10-year, we were adding some cyclicality to our equity portfolios because we had a lot of staple names. So trying to balance that out. So I think you need to be tactical. Take a little bit of a short-term view and make small trades. Don't make big bets in a market like this. That's where I think people make mistakes, Lisa. Let's be tactical. Let's be opportunistic, but you also have to be cautious and be a little more conservative in your allocations.
Victoria, this was great, as always. Victoria Fernandez there of Crossmark Global Investments. I think capturing the feeling a lot of people have right now, Tom.
Yes, yeah.
Especially those that missed out on this rally here today. This feels odd. I don't know what to do with this.
Exactly.
Let's frame this correctly, and the value of having Victoria on as Crossmark is it's not big banks, it's not strategy, it's not marching orders on a Monday, this is our bank message or whatever. Crossmark is out there with real portfolios, real money at risk, away from the idiocy of the island of Manhattan. And that's the massive value where Victoria and her team are saying something isn't right. I mean, everyone feels
sometimes it takes confidence to do that. I think a lot of people on TV, they think the secret is have conviction, have something to say, have absolute belief in it. I think you come into this year and you look at the incoming information, you see jobs come in at 517,000, unemployment dropped to 3.4%, claims at 183,000, and we'll get an update on that in 20 minutes. And then you see wage growth not accelerating and disinflationary trends starting to take shape, and you're just wondering, where's this one going?
Yeah, and people talk about a rolling recession, but I love Victoria's comments basically saying it's not great to hear from your money manager that something's not right because it's kind of vague. But if you aren't confused but with where the economy sits right now, I feel like you aren't looking at all the data, and that really is the takeaway from all of the different signals that we
Julian Emmanuel said exactly the same thing. Julian was saying, if you're not confused right now, you're not paying attention. And I think that sums it up, Tom. If you're not confused right now, you are not paying attention.
Yeah, I agree with that, but I will also say, and this goes back to Ralph Van Kampoor's heated interview, the giant technician, where he said October was a low. This is the kind of jumble and something isn't right you get before bull markets happen. There's a lot of gloom. There's a lot of people not playing. I go to that JP Morgan chart of 3 days ago showing the huge amount of people that have disbelief in this market. And I'm sorry, I walk in, and John, I look at the NASDAQ up a stick, and I really don't know why, other than some good earnings.
It's like David Lebovitz sat there and said some of the earnings haven't been great. Yields are actually higher again, but tech's rallying. And he couldn't figure it out. It's like all roads lead to the same question. Why is tech rallying? Why is tech rallying and yields are higher?
Because they believe in Lisa's immaculate disinflation, period.
Is that really what it is?
I think it's a duration play, and as somebody
Short
said,
squeeze.
I'll give credit.
Positioning story.
No, they're having cost, they're
cost rationalization. Yeah,
they're
then all of a
trying to
sudden
act like
cuts.
adults.
All right, maybe.
But the cost story is a
maybe
factor.
is the right answer.
Look at Meta a number of months ago, who really kicked this all off. Facebook has rallied so hard since then. How dare you try and overspend in a rising interest rate environment? And this market slapped them so hard they came back with some massive cuts.
Although still, we haven't really addressed the existential questions around the growth in their platform, right? So again, there still are some of these hanging over questions, but are cost cuts enough to cut to growth?
Hey, we're going to see. Made me think of Credit Suisse. Where's their stock now? Credit Suisse at the moment, down 7.7%. It's been a rough morning for them, hasn't it?
It's been a tough time. How do they bring back? How do they bring back all of this?
How do you say in February, Tom, 2023 is a write-off, see you in 24?
To their credit, their PowerPoints are clear and hugely detailed. What a mess.
Huge mess. Stock's down 7.7%, equities up 0.7% on the S&P.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky is in Brussels, the third stop on his quick trip to Western Europe. As he did in London and Paris, Zelensky is seeking more military aid for the war with Russia. European Parliament President Roberta Metsola said allies should consider sending long-range missile systems and fighter jets to Ukraine. The death toll has now gone over 16,000 from earthquakes that struck Turkey and Syria. Rescue crews were still finding survivors more than 3 days after the quakes hit. Meanwhile, the U.S. has deployed an aircraft carrier to the region to provide assistance. Credit Suisse warns it faces a substantial loss this year after clients withdrew a record $120 billion in funds in the fourth quarter. Confidence has been deteriorated in the Swiss bank, which posted a fifth straight quarterly loss. We spoke with CEO Ulrich Korner.
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program, to create a new Credit Suisse, much more focused, simpler, built around client needs. In the midterm, very profitable.
Credit Suisse's trading revenue has plunged 96% in less than 2 years. And PepsiCo reported fourth quarter profit that beat expectations. It's a sign that shoppers are willing to pay more for higher prices set on beverages and snacks. This year, PepsiCo sees organic sales growing 6%. That also beat Wall Street expectations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Ulrich, thank you so much for speaking to Bloomberg. We have results. Your first gut feeling about them?
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program, which we, as you know, communicated end of October, to create a new Credit Suisse, much more focused, simpler, built around client needs. In the midterm, very profitable, and we are executing at pace. And let me also say, we are confirming all our targets we gave by the end of October.
So when do you think results will be acceptable? When will they be at a level that you're comfortable with?
Look, we said this is a three-year transformation. We gave targets on return on tangible equity. As you know, we reconfirmed them. So it will take some time. 2023, certainly a very transformative year. And then we get better and better.
What's your outlook for asset flows?
So we have seen what has happened in October. let me say that, the outflows we have seen basically are more than 85% stemming from October and November. And if you click only in October, it's more than 60%. So what we did immediately after we could communicate end of October, we put in place at least what the colleagues tell me, an unprecedented client outreach program. So we talked in the meantime to more than 10,000 wealth management clients, individual as we talk, and more than 50,000 clients in Switzerland. And I think that has created very good momentum. So if I look into January, the group overall is net positive on deposits, wealth management globally as well, wealth management Asia Pac as well, wealth management Asia Pac being positive on net new assets, and Switzerland as well. So I think the situation has changed completely.
So is this a trend that you believe will definitely continue, and where are these inflows coming from?
They are coming from different geographies, different places in the firm. As I said, Asia very positive, Switzerland positive in terms of net new assets, other areas as well. So I think it's a really completely changed situation.
When will Credit Suisse be reliably profit again?
Look, that is a far-reaching question. We said very clearly we will make a loss in 2023, and from there on we will get better and better.
But could it be 2024, or does it have to be? I mean, I think in the past you've said 2024, and then analysts are saying, look, it could actually be 2025. Does it make a difference to when you hit that target?
Look, the difference is how we execute and how the long-term attractiveness for our shareholders will look like. That will be very attractive. But nevertheless, 2024, I think we should be profitable.
Any cornerstone investors that you've been able to lock in?
You mean with respect to CSFB?
Yes.
So we had, as we said already in October, we had strong interest there. We have several investors now being interested in coming in. We first wanted to do, as you have seen, the transaction with M. Klein and Company, because that's an important step to accelerate the transformation into CSFB. And now we are, in very close contact and discussions with several investors potentially coming into CSFB.
And so, what's the transaction looking like? For example, with Michael Klein, how much equity does he get?
So, as we communicated, so we pay 175 million for his very good firm. This is a very fair price, I would say, and this is a very accretive, earnings accretive transaction immediately, and it will strengthen our advisory capabilities, very obviously, and therefore accelerate also our transformation into CSFB. So I think look, the whole transaction and the whole setup, as we discussed already in October, was done to create long-lasting, significant shareholder value. And this transaction is one step on their way.
Do you plan on buying other boutiques, actually, to change?
No, we said, look, the two main carriers which we are working on is the new Credit Suisse and CSFB.
Talk to me a little bit about client onboarding. So if we go back to some of the inflows or outflows, are you changing risk management or anti-money laundering because there was a problem in onboarding previous clients?
No, I think we have done a lot of risk remediation over the last 2 years. Actually, we'll do more this year, but I think in this respect we are absolutely fine, professional, and we onboard. We are even getting faster in terms of onboarding, so that's all well underway.
Talk to me a little bit about compensation. I mean, this certainly created waves. There was talk about you delaying compensation or doing it in 3 tranches. What is the reasoning behind that?
No, we are not doing it in 3 tranches. So we have had a big, so to say, compensation day like the day before yesterday, and there were very small parts of the firm, particularly seniors in CSFB, where it was delayed a bit. But we are doing that over the next couple of days. But overall, it was done globally, more or less at the same day.
So, what's your strategy on compensation and bonuses?
Look, the strategy in quotation marks is pretty simple. It needs to be in line with the results, more or less, and I think that's the current thinking and the future thinking. And I think that is also something which is very important. If you think about New Credit Suisse, that provides us with the opportunity to create also a new culture, and that is all what we are defining now. And I think the new culture, when it comes to compensation, in principle, going forward, will be: you make profit, you pay bonus. If you don't, you pay the very little or nothing. So that's the culture around bonus going forward.
Are you reallocating bonuses actually at the bank, like how you think about it?
What do you mean by reallocating?
In terms of the units. So is it seems pretty, I guess, intuitive that if you make a profit or if you do good, you have bonuses.
Yeah.
But are you taking some away from certain people to give it to others? Like, how has that changed in the last 12 months?
Look, no, in principle not. But the only thing which we are doing, obviously, is, as you have seen, we cut the bonus pool significantly, which you would expect, I guess, in a year like last year. But then we make sure, and that's maybe the only overlay we are creating to make sure, that we can really keep the franchise. And in this sense, it might be that, a little bit goes more left than right and so on, but in principle, it goes on the underlying results.
Are you worried about people leaving the firm?
Look, we have a tough bonus round in this sense. We are in competition with all our friendly peers. But on the other hand, I believe very strongly in that one is, New Credit Suisse, but also CSFB for our important colleagues on that side, creates really something which they can believe in. This is something new. This is a very, very good story, will be very profitable on both sides, and that is something people believe in.
Todd Bubba Horowitz is back. He is the chief market strategist of BubbaTrading.com, and we'll be talking about everything to do with his trades, his favorite trades of the year, his favorite trades of the week, and his least favorite trades of the year, equally important. Welcome back to the show, Todd.
David, it's great to be with you as always. It's always a pleasure to be around you.
Great to have you on Kitco. Great to host you. And let's recap what happened this week with data first before we talk about what's next. So as you know, we're speaking today on Friday. CPI data came out yesterday, 6.5%. CPI has been on a downtrend for many months. In fact, President Joe Biden came out and made an announcement, and he was telling the American people that he has good news. Inflation has been coming down.
When you've seen issues between the U.S. and China, China has taken a relatively measured response to chips bans, to other sorts of measures that have been placed on them, not just by the U.S., but by the Europeans. There is a recognition that China does need the West, and the West needs China. How that ultimately manifests itself from a geopolitical standpoint is a real question, but trade data still seems static at this point. There doesn't seem to be any material disruption.
It just seems to me, though, and to build on what Lisa said, that the two main geopolitical challenges that the US faces right now, whether it's Russia or China, that Germany seems to be the weak link in both. What can be done about that?
I mean, look, right now you're beginning to see companies sit and war game what a potential escalation of Chinese aggression could look like from a Western resolve, from a sanctions standpoint, and what is the business impact. So you're seeing businesses that were caught flat-footed on the Russia invasion and what that meant for their businesses in Russia begin to look towards China and prepare accordingly to make sure that doesn't happen to them. Not to do anything preemptively, although there have been movements of supply chain out of China to diversify. But you're seeing a lot more companies take seriously what could happen to their businesses in the event that China escalates things, and to have a playbook on the shelf now.
How did they spell your name, just out of interest?
They added a third N, which Ellis Island was nice enough to remove.
Okay, there we go. A sanctioned Dan Tannenbaum
Third N
of Oliver Wyman.
3 N's. T-A-N-N.
Tannenbaum.
Wow.
There we go. I mean, it was worth asking.
They'll never find me.
I was just... Coming up at the Open, Jim Bianco of Bianco Research, Megan Green of the Kroll Institute, Tony Dwyer of Canaccord Genuity. Fantastic lineup as we count you down to the opening bell in about 5 minutes' time. Mike McKee in Dan's seat, breaking down jobless claims for you.
I just noticed Tannenbaum's is cut and chiseled as Sean Penn. I mean, that's.
Do you think that they mistook him for Penn?
Yeah, I think
that's
so.
what happened.
Stiller,
Maybe.
Penn.
It's the nicest thing he's ever said to me.
It's possible.
Aww.
It's downhill from here, Dan.
Yeah.
Happy
Downhill from
Valentine's
here.
Day.
Was that your gift to Dan? That was beautiful.
It's inflation.
Just lovely. Beautiful.
Right now look pretty good, up 250. Part of that is Disney. Sarat Sethi is a managing partner and portfolio manager for DCLA and a CNBC contributor. He's got a lot to worry about, a lot of money to spread around, $7 billion plus, right, Sarat? That's why, I don't know, are you sleeping okay?
I sleep okay, but it's not easy time, especially when clients' capital, is where it is at this point. But
what about Disney?
There is some good opportunity out there.
Yeah, you positive on Disney?
I am, Joe. I was listening to what you guys were talking about this morning. I think Iger's doing a great job. He's looking at the organization. Your points about having the creators actually be responsible, accountable for the P&L, I think is very important. And I think, this is a way for Disney to kind of come back to what it was. The stock was, $200 just a couple of years ago. COVID was not good to it, but separating the businesses, the core businesses are really worth a lot more than what we have. And it's a cash flow company. I think reinstating some type of dividend and focusing on what Disney's really all about, I think will bring some great value back to this company.
I guess looking at those three divisions, I guess it makes sense. There are times I do wonder about ESPN and how it fits in and how much it would be worth outside of the company. But they apparently considered it. But before Iger came back, they considered it and decided not to spin it off. Now that he's back, do you think is that going to stay that way, or would they revisit that?
So I think the way they've structured it implicitly in there is to say, okay, we can actually separate the financials, make it public disclosure, and give it some time. And whether it's 12, 18 months, if it's performing well, you can actually use it as a potential to either spin.
Hey everybody, welcome to Trading Capital's daily live stream of the market open. It's currently 8:30. We have some important key economic data that is about to be released in about 10 seconds. So we're going to see yields potentially either spike or drop. Dollar could either pop or drop based off of this data. So we're just going to watch the S&P for a reaction here and see what transpires. So far it's very quiet. S&P is getting a little bit of a pop, gapping it up. Dollar's falling. I don't know the data yet. The data came in better than expected. 196,000. 196,000. So that's going to should be negative for yields, but the market hasn't really reacted yet. 196,000 on payrolls. Market's liking it right now. Let's take a look at the dollar. DXY really isn't moving. So it really hasn't moved markets much. You're starting to see a little bit of a rally take place. So non-farm continuous job loss claims came in line. Initial job loss claims came in at 196. So it's showing that the labor market is remaining strong, but the yield market hasn't really reacted. It's actually fallen slightly, which is interesting. Very, very intriguing. Now, often the markets love to gap people up and then reverse them. So let's just be cautious about this. Even though the dollar and yields aren't really moving, it's gold isn't moving either. So if we actually look at gold, gold is still putting in this beautiful, beautiful bear flag of consolidation. Picture perfect. So it's really not really that big of a movement occurring in the S&P. So that being said, the markets remain strong, neutral, positive upside. And then the next data set is natural gas storage, which we can actually pop to that right now. We're going to have a bunch of different levels to trade, so I'm going to encourage you to come back to the live stream. Natural gas is trying to get a little bit of a pop here. Let's flip back to the Dixie. Dixie's still just holding this little support area. So we'll see what transpires. but really no movement there from the jobs market. Take a look at Tesla. Tesla's still gapped up, coming in a tiny bit now. Microsoft is also gapped up. MSFT gapping up. So now that we've got that data digested and the market's really not moving off of it, you're going to have a neutral to positive bias, but typically, from my experience, when they gap it up in the pre-market, they like to reverse it later on in the session. So we're just going to be mindful of all the possibilities. On that note, I'm just going to run some numbers, analyze some charts, find some trade setups, and we'll come back on the stream in about 30 to 40 minutes, prep you for the pre-market open, just to see if there's anything else we're noticing. You did have strong earnings across the boards from AstraZeneca, Pepsi, but Pepsi's fading. ABBV, AbbVie's seeing some distribution, but not Affirm is still down. So we should have some potential trade setups this morning, but we're just going to wait for the market open, see if there's anything else that drastically changes, and then we can look to potentially plan at our levels and start the trading day. So on that note, we're going to cue you back into Bloomberg.
Expectations for Fed rate hikes. In other words, people are seeing even more value in buying 10-year treasuries for 3.6%, which are yielding the least relative to 2-year treasuries going back a long, long time.
We're back to December 7th on that. We're not through that. Maybe we'll breach the December 7th level of last year here in a minute. On the American economy now, Luke Tilley joins us, chief economist, Wilmington Trust. Luke Tilley, the state of the American labor economy, it's a jumble to me. Claims odd, jolts odd, everything odd. What do you and Wilmington Trust make of our job economy?
Yeah, it's obviously an incredibly tight labor market, as Mike was just saying. The low level of claims really syncs up with what we saw with job growth in the month of January. Interestingly, if you look at the non-seasonally adjusted numbers, you usually get 2.8 or 3 million lost jobs in January. This time around, this past January, you get a loss of 2.5 million jobs. Of course, the seasonal adjustment pushes that higher. And what we really see is in this tight labor market, employers are holding on to their employees. We know how challenging it is to hire people. So it's really more of a story of wanting to hold on to people. That's the story behind the strong jobs number for January. And we're also seeing that with the claims this morning. We think that the job growth obviously is very strong, but it's more about the differential. You just referred to the jolts, jumped up on a 1-month basis. It looks a little bit fishy. Before that, it had come down more than 10%, but it's really the mismatch that's going to matter more than total job growth, Tom.
Is wage growth going to cooperate so Lisa can see her immaculate disinflation?
Well, we've already seen, I hear people talk about, is it possible to have this immaculate, disinflation? It's easy to point out that we've already had it for 3 months, right? This is not just a one-off. You've got 3 months of much slower inflation while you still have the strong wages and the tight labor market. We think that it's going to get much more challenging when you get to the middle of this year and beyond because the labor shortages are going to persist. We also see supply chain challenges, and then also the energy transition is going to keep some upward pressure on inflation. So we expect it to keep coming down in the near term. We're encouraged that average hourly earnings actually were pretty mild with the 0.3% increase. And if you look at production and supervisory workers, the slowdown in wage growth from last year into this year is even more encouraging.
So if you do get some noisiness, but you do get this sense of disinflation just based on the year-over-year composition of the way that the data is drawn up, how do you then get confidence? How do you give confidence that there's going to be a stickier inflation later in the year when all anecdotal evidence is speaking to the other?
Yeah, well, we think that it's going to keep coming down on a year-over-year basis. As you point out, you've got those base effects. We just don't think it's ever going to really come back down to what we saw between the global financial crisis and the COVID pandemic. We've got higher inflation on a trend basis now, between 2.5% and 3.5% on a multi-year basis going out. It could dip pretty low in the middle of this year. We know what's going on with shelter. And even if we just see the shelter numbers flatline, that would imply some very low inflation numbers. Wilmington Trust were much more focused on 9 and 12 and 24 months out. And those higher inflation numbers are going to keep rates higher and actually offer some opportunities for investors. So it's not a whole lot of confidence, Lisa, about what the month over month or even to the middle of this year has a lot more to do with that longer term trajectory. We see those challenges. We also think they're navigatable.
Well, navigatable, which really speaks to the Torsten Slok no landing kind of scenario at a time when a lot of people are pushing out potentially even for years any type of recession. Are you among those?
Yeah, it could go out or it could happen this year. You know, we've got basically a 50-50 chance, we think, of a soft landing versus a mild recession. It's going to come back to employers. We know that employers are dealing with higher borrowing costs, a little bit of softening in demand. If they keep hiring, then, you know, you've got consumers, you've got job growth, you've got wage growth, and that'll keep the economy's head above water in the middle of this year. If companies get spooked and those higher borrowing costs hit their capex and their hiring decisions, well, that's going to lead to recession. I actually think it's going to have a lot more to do with the lagged effects and all of the hikes that were last year, much more important than whether the Fed stops at 5 or 5.1, you know, 1 or 2 more hikes here and there. Businesses are reevaluating those capex decisions now.
Luke, you earned your stripes at the Philadelphia Fed, which has one of the most interesting research capabilities, given the terrain, given the geography as well. And to me, it really harkens back to the study of the core American economy, which I'm going to call domestic final sales. When you take out the foreign dynamics, the inventory dynamics, and you just look at this thing, domestic final sales, is it half full or half empty?
We've definitely seen the slowdown, and that's our preferred measure. It's a little bit like looking at core CPI, right? You strip out the international. We actually go with private final sales to strip out the government as well. And what we've seen there is an appreciable slowdown in the economy. I mean, it was just barely positive for the most recent GDP report, I think 0.2%. And what we see there is a natural slowdown that was going to happen anyway from COVID, but it's also the impacts of the Federal Reserve's policy. We know that residential investment has been hit very hard, and this is exactly what they're trying to do, is to engineer that slowdown in the economy. And Powell referred to this just the other day, the final sales numbers, because what we do see is that slowdown that should help to bring inflation down. And of course, we need to wait to see which way that breaks.
Luke Tilley, thank you so much with Wilmington Trust this morning. Lisa, it's a stunning chart. And, you know, you have a pandemic collapse to negative 9% on final sales to private domestic types, which Mr. Tilley talks about. And then up we go to the stimulus boom of a positive 15% statistic. That was for a cup of Tang. And then we come right down, and we're settling right now on a moving average basis, on any form of annualized basis, actually below where we were for 8-9 years.
And what's behind it, right? And actually, Justin Fox, a Bloomberg opinion contributor, wrote a column that's fascinating about how manufacturing jobs really are coming back to the United States in a way that they really hadn't for decades. You see certain areas of industries where the landscape has shifted, right? You could talk about globalization. You could talk about, you know, the durability, the sort of, you know, safety, the security of trying to diversify your supply chain. But that's what's perhaps underpinning some of the resilience in a labor market that isn't weakening.
And the view forward, and this folds back into the Credit Suisse soap opera, is the financialization of the elites in America, which is away from prosaic things like manufacturing, is now within a regime of higher interest rates, whereas Winnie Caesar said money actually costs something. Well, and it's a whole new world. You know, let's go to Disney. It's a whole new world after all.
Which really goes to the Mike Wilson view of things. Can you get an economy that's resilient, a no landing, and still get a rationalization in valuations based on money costing something? Valuations in the equity markets. And that's, I think, one of the questions. You get a reversal of some of that financialization of the U.S. economy that perhaps is getting unwound just a bit.
I talked about today, early morning, I talked about what I looked at first thing Monday, which was the Value Line Geometric Growth Fund, and it gives you this ambiguity right now. It's actually behaving in a very constructive trend up basis, with futures up 30, NASDAQ up 1.2%. I don't have my radar on Dow 35,000. I mean, John Farrow does.
Oh yeah, he's all into that.
He has the hat. Extrapolating out to 35,000. He's probably got the hat from the last time it was in there.
Absolutely.
Coming up, Catherine Rooney Vera, a chief market strategist. We'll do this at Bulltech Capital Markets. Stay with us. This is Bloomberg Again. Futures advance up 30 points.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky is in Brussels, the third stop on his quick trip to Western Europe. As he did in London and Paris, Zelensky is seeking more military aid for the war with Russia. European Parliament President Roberta Metsola said allies should consider sending long-range missile systems and fighter jets to Ukraine. Rescue crews continue to pull survivors from under the rubble of collapsed buildings in Turkey, but hopes are starting to fade more than 3 days after two massive earthquakes killed nearly 18,000 people in the country and Syria. The U.S. has positioned an aircraft carrier in the area for some assistance. President Biden is dismissing questions about his age ahead of what's expected to be a re-election campaign. In an interview on PBS, the president was asked about concerns some Democratic voters may have about his health and fitness. His response, quote, "Watch me, it's all I can say." President Biden is 80, the oldest president in U.S. history. British billionaire Jim Ratcliffe has hired J.P. Morgan Chase and Goldman Sachs to advise him on a bid for Manchester United. The English Premier League club has drawn takeover interest from Qatar. Manchester United is one of the biggest brands in global football. There's one estimate that it will sell for more than $4.9 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
All right, we're getting some headlines from the Disney investor call. Cost cutting is the theme, and you can see investors reacting to it with shares up more than 8%. Disney is looking to find $5.5 billion in cost savings and will be cutting 7,000 jobs to help do so. CEO Bob Iger also announcing the company is going to restructure into 3 units. And here's the key: Disney Entertainment, ESPN, and Disney Parks Experiences and Products. Praz, what's your reaction?
A lot to parse there, right, Dave? So you hear about those cuts, $3 billion coming in from content alone, but they're not touching sports, right? They're not touching sports. They're leaving that alone. Street loving 7,000 job layoffs. It's hard to say that, but it's true. They do. It is going to be a big cost driver for the company. And then also talking about ESPN, now its own separate unit, right? So what does that mean for the company? Does it make it easier to maybe spin off? Is it easier to account for? Is it easier to kind of separate a sort of still growing or still sort of very valuable property for them? So I think this sort of Iger putting a stamp on things right now, and this is what he's doing.
Yeah, 7,000 cuts. That's about 3% roughly of their 220,000 employee worldwide headcount. So not a significant number to the likes of some of those we've seen in the tech sector in terms of a percentage. So theoretically, without hearing from Bob yet, presumably these are high priced. Probably some executives are going to roll here, not the people that are dressing up as characters, because they're going to have to spend a lot on this labor agreement. 96% of the employees turned down their recent proposal, so they're going to have to really spend up on those employees. I don't think ESPN's going anywhere. I really do not. Hulu is the big question. Will they buy out the remainder of it? I'm going to go yes. What else do you think might happen today?
That's a big point. Rich Greenfield talking about how he might address that big Hulu question mark. What's happening? What's the future of that? Do they even need it when they have Disney Plus, right? Absolutely right about the parks business, the how we renegotiate sort of labor contracts there. It's a booming business. They want to get that addressed. They want to lock that down, get those costs under control, and potentially, kind of have some forward see-through there where they can actually keep it kind of constant. ESPN. This is the big debate, right? Where is that going to go? And I think you make a big point. It's a valuable property. Maybe Disney wants to hang on to that, and then kind of connect with ABC networks, right? So I think that's all part of the whole genesis. This whole part of the kind of all the parts coming together for Disney, and we'll see what Bob Iger says later today.
Good to have parks when they're up 20+% year over year.
I think that the equity lift today is interesting is because it comes after the 1.7% decline yesterday in the NASDAQ. Have we reached the point where people are not in the let's just make it rally kind of mode or not? And this move that we're seeing ahead of today suggests people are still looking to buy more than they are looking to double down.
It has to do with the earnings as well. This is a joy. Right now, we're going to go down memory lane, which was that long ago and far away with a guy named David Malpass, who's got a job in Washington right now holding up a bank. There was, at Bear Stearns, absolutely definitive emerging market coverage. There was something about it in the air, in the pixie dust, and Catherine Rooney Vera was part of that. She's chief market strategist, head of global macro research at Bolta Capital. I've got to go back to Emmy Shio and David Malpass and all of it. What was it like? Is Bear Stearns literally, in my opinion, invented EM coverage on Wall Street?
Well, thank you for that kind introduction, Tom. And Bear Stearns was fun. It was a great place to work, and really I miss it. But EM was a strong point. David Malpass, John Riding, Emmy Shio, as you mentioned, some of the heavy hitters. I was in emerging market fixed income research, and so enjoyed that time, yes.
But, it was a different battle, but then it was EM connected to the central, as Bill Rhodes would say, the central banker to the world. Is Jerome Powell right now the central banker to Emmy Shio's Latin America or the Pacific Rim? What's the power of our central bank leader now?
Well, emerging markets do very poorly in a Federal Reserve hiking cycle with the dollar appreciating in value. So that's why we saw emerging markets get devastated last year. And I think, Tom and Lisa, that's why we've seen emerging markets be the new darling year to date. It was one of the worst performers in 2022, and it's one of the top performers this year, precisely because it seems the Fed is maybe going to stop pretty soon. I still think it's a bit early to jump into that trade. I think that the momentum could carry us higher for the next month or so. But the Fed could do more, and more than the market is currently anticipating, as your guests have ad nauseum mentioned. But there's a certain euphoria, I think, right now for the riskiest paper and for the mean reversion trade.
Euphoria. Can you build on that? What is driving the euphoria other than just, I guess, positioning squeeze?
Yeah. I was talking with your previous guest in the green room, Winnie, and she called it, everyone's jazzed about the China reopening trade. And that's fantastic for emerging markets. China is a very important trade partner for Latin America, and it's very important as well for Asia, ex-China, right? So as China reopens, the surrounding areas, Malaysia, Thailand, those areas are going to get a bounce in tourism, and Latin America is also going to benefit. So I think there's that aspect. A weakening dollar is very favorable for emerging markets. Economic growth this year is going to be stellar in emerging markets. India, more than 6% growth. China is going to lead the growth. And that's going to be positive versus the developed markets. We're here in the U.S., in my view, we're going to be flat at best.
Well, but so do you think that, just to sort of put something concrete around this, do you think that right now the China reopening has been fully priced and even overpriced when it comes to how it's been represented in emerging markets, just riskier assets in general?
Yes, and I think that before I recommend going long on a sustainable fashion to institutional or even retail investors, we do have to see a pullback, a correction in risk assets. I think the U.S. recession is not priced in, particularly in the equity markets, and we have not seen difficulties with financing. There's a lot of names in the emerging space, as well as in high yield, that have not had those financing difficulties that I do expect to come to the fore as we feel the repercussions and the ramifications of 500 basis points in tightening in more than a year.
Two things right now, very important. You're lecturing at the University of Miami, and you're going to tell them we just had a new depth of inversion on the 2-10 spread, negative 85.298 points. 3-month 30 is at 107. It's not through to new depth yet, but there's the vanilla spread. What is the signal of new deep, substantial inversion?
Yeah, it's been really fun to be an adjunct professor at UM teaching global economics, especially, Tom, in this time in our lifetimes. Look, I'll go back to emerging markets again. They did their homework. Brazil increased rates more than 1,000 basis points last year alone. So I think that's part of the euphoria, plowing into these countries, these names, these geographies, these asset classes that are very juicy in yield.
Okay, I've got to ask Lisa. Lisa asked for me as well. Both of us tried to price a condo in Miami the other day and fell off our chair. You're living it. You're living the Florida boom.
I'm a beneficiary of it.
You're a beneficiary of it. Okay, give all of our listeners and viewers worldwide a snapshot into the sustainability of the Florida boom. Can it continue?
The good news is that we have diversity both in, the diaspora from New York, New Jersey, and from Latin America. So all those people are coming. So it's not just the New Yorkers that certainly have bid up, not just my house price, Tom, which has jumped significantly in value, but also the wait list to get into schools. It's very difficult now to get into the private schools because of this influx. I think it is diverse. I think the mayor and the politicians there have done a fantastic job of enticing capital, and it's diverse in nature. So I don't envy you looking at real estate in Miami. I'm one of the New Yorkers that moved down, but thankfully 15 years ago,
Lisa,
when Bear
4
Stearns went
bedrooms,
under.
3 baths, and there's grass coming up through the driveway.
Yeah, we have a yard.
$2.5 million.
Basically, the most interesting thing that you've said in the, not Florida real estate. I'm still looking at the 210 spread, which shows you how much of a nerd or whatever you want to call me. But I'm watching right now equities rally, continue to extend the rally, even though people pile into 10-year treasuries at a time when they're expecting more rate hikes. This doesn't add up. Do you understand this, Catherine?
No, and I think Victoria Fernandez said it very well. It doesn't add up. And so that's why I like T-bills. I've been saying this for an extended period of time. In fact, here on Bloomberg a couple months ago, 4.7%, 3-month, 6-month T-bills. It makes sense to me. I think it's a good idea to be in cash and cash equivalents. Some of my top picks in the equity space last year I continue to like, which are staples, underperformed this year, utility, energies, and healthcare in the equity space. And I think we do need to remain defensive under the expectation that this can't continue, right? We can't have record low unemployment in 53 years, productivity really kind of dismal, and labor costs still rising with the Fed getting to its 2% inflation target.
We're going to have to see. Thank you so much. Catherine Rooney-Vera with us
Pleasure.
of Voltec Capital Markets, joining from Miami. It's good to have the Miami view. I mean, are you and I going to be the last two people here? Pharaoh's, I think, destined for Miami.
What, you think so? You think he's a Miami person?
Yeah, he's like, he's cut and chiseled, and he'd be.
Are you going to wear like a short sleeve polo with a bow tie?
It's not me. I went, I've been down a couple times, and
you're not a beach kind of guy.
No, it's not the beach kind of guy. It's just the Florida thing. I'm trying. I can't get there.
Yeah.
A lot of our guests have moved.
Yeah, and a lot of it's been some of the tax shift that they're doing too. I want to build on what you were talking about, the 210 spread.
I agree.
I think that's notable.
Seriously, folks, this is an historic moment right now that we're having.
What you're seeing is the deepest inversion there going back decades. We now reached a new low, not on an intraday basis, but on a closing basis, just to give you a sense. But what this indicates is that people are willing to accept that much lower of a yield to invest for 10 years than in the short term. Again, why is tech rallying in the face of this? Is it just that valuations still make sense? And maybe they do. I'm not saying they're not, but it raises a question.
I'm going to go back to Peter Fisher of Dartmouth and his public service to the nation, which is it's a 4-box prisoner's dilemma, and that the 10s are moving, the 2s are moving. You can have up, all down, or moving like this. On radio, this is really working out. But the answer is the ambiguity here is massive, Lisa.
Although the Fed's going to have to keep raising rates, and that has been the conclusion pretty broadly from the bond market.
Into the morning, into the next hour, futures up 34. This is Bloomberg Surveillance.
The biggest spread, the most deeply inverted yield curve we've seen going back to the early 1980s. Equity futures still elevated on the S&P, up 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, President Biden expects the U.S. to avoid recession. Credit Suisse flagging substantial losses in 2023. And Disney cutting 7,000 jobs as Bob Iger looks for savings. We begin with the big issue. Corporate discipline returns.
Obviously, you're seeing some margin pressure here.
The recent layoffs.
You're seeing the cost cutting.
As companies are trying to figure out, how do I manage my balance sheet?
Companies are going to lay off workers when there's margin pressure.
They're focusing on the cost cutting.
Look, they're doing what they need to do to maintain profitability.
The Band-Aid ripped off.
The primary lever that they have to pull to defend their margins is reducing their labor footprint by reducing their employee expenses.
Protect free cash flow.
What I see is just broad-based margin pressure.
Margin pressures are going to be a significant headwind.
The cost cuts can only get you so far.
This is all about execution now.
Two key words right now, disconnect and discipline. Kroll's Megan Green joins us. Jim Bianco of Bianco Research. Megan, first to you. Let's talk about a disconnect. Do you see a disconnect at the moment between what you hear from the C-suite in America and what you see in the economic data?
Yeah, absolutely. Clearly, with the last jobs data being so incredibly strong, there's also a disconnect with headlines, right? We hear a lot about layoffs in the media, but it's not particularly broadly based. I do agree, though, that it could turn on a dime. So I do think that the labor market has held up so well, in part because there is a lot of labor hoarding. We don't really know how to measure it, right? It's anecdata more than anything else, but we do know that it's happening. And so it is possible that as corporate earnings fall because rates continue to go up, companies decide they're not going to hang on to those workers until the other side of this. They may capitulate, lay people off, and then I think we would get a broad-based downturn. In fact, that's what I think would push us into a recession, even more so than household savings being whittled down. If people start losing their jobs or their friends start losing their jobs, that's when they really retrench, and consumption is about 70% of our GDP. So I think that would be the real spark. It's just impossible to guess when it might actually happen because we haven't gone through this kind of labor hoarding before.
Looking at the numbers for jobless claims, and that's where you'd look for signs of weakness. 196,000 is the print. Just to come to you on that, Jim Bianco, that's the first pickup in about 6 weeks, but still, sub 200K. There's some pretty stellar numbers, aren't they?
Yeah, those numbers are very good. You would not associate any kind of a slowdown or recession with the claims numbers being that low. And as far as the layoffs go, for right now, the layoffs are really concentrated in tech and other high growth industries. After last year, I think a lot of these companies are being told it's time now that you start showing profitability or a path to profitability, and you just can't keep hiring people and losing money or not making a whole lot of money and promising us that down the road many years from now you will make money. We want to see it now. And keep in mind, too, with a lot of the layoffs that we're seeing, these are announcements, and we're going to lay off 7,000 people at Disney, but that could be through attrition. It could take a couple of years. It's not going to happen all in 1 month. And so this will not really show up as some giant spurt in the claims numbers.
So, Jim, that's good news for some of these equities, and maybe Meta. Facebook's a decent example of that. Discipline returns, the stock rallies. Lisa Shallard of Morgan Stanley said there was a massive disconnect in this equity market. She said history is not kind to these kinds of massive disconnects. Can you relate to that?
Yes, I can, because when you see the market switch on a dime and tell companies that we're high growth companies, don't worry about your profitability or your margins right now. We want to see big growth in the future. And now we're going to turn and say, okay, you need a new business plan. You need to start making money right away. That's easy to say. That's almost impossible for a lot of these companies to do. The managers, the culture has always been about trying to figure out a way to make money in 5 years or in 10 years, not to make money in the next 3 or 4 quarters. So it's going to be quite an adjustment for some of these companies.
The other disconnect might be what's developing in the bond market and what's happening in equities right now. We've got a 2-year, 10-year spread at negative 85 basis points. As I mentioned at the top of the show, that is the widest spread, the most deeply inverted yield curve going back to the early 1980s. 1980s. Megan Green, what kind of signal can you take away from what's happening in the bond market right now?
Yeah, I mean, a yield curve is an indicator that a recession is coming, but it doesn't give us any indication of what the choreography is, what the timing is, how deep it is. So just because the yield curve is even more inverted now, I wouldn't take that much from that. I think a better indication actually is the labor market. It's a better indicator than any economist or the yield curve in terms of predicting a recession. If we see a jump in unemployment of a certain amount over a certain period, that's the best indicator for a recession. And as we've just mentioned, we're not seeing that. We're not seeing a deterioration in the labor market. And so, the chances of a recession have gone down a little bit. That being said, I think we will see it as the Fed continues to ratchet up rates and also continues to shrink its balance sheet, which most people have kind of forgotten is happening in the background. But that is a significant tightening as well. So I wouldn't worry so much about the yield curve. I would worry more about the labor market.
We have hardly talked about QT. They wanted it to operate in the background, and maybe that's the way it's going, at least for now. Jim, I've always thought that if I'm willing to accept a yield that is 85 basis points lower on a bond with a maturity that is 8 years longer, that there must be some kind of signal the market's sending to me. What kind of signal is it sending to you?
Well, yeah, I mean, historically, as Megan said, the signal is that a recession or a downturn is coming, and that could still be mid-24. It could be as far as 18 months out in the future. And also, as Megan kind of alluded to, too, is that the more inverted the curve gets doesn't mean the worst recession. It's kind of all the same kind of signal, whether it's 20 basis points or minus 200 basis points. It doesn't signal that it's worse because it's more inverted. It does suggest a broad-based slowdown will be coming. That's what the market is anticipating. But I think what Wall Street's mistake is they think that's March or April. But it might be March or April of 24, or it might be June of 24. And I'm not so sure that Wall Street has the patience to see that the recession is going to maybe unfold a little bit slower and longer than they think.
Well, corporate America's making a move. Disney, the latest, putting their cards on the table. We're looking at 7,000 jobs to go, $5.5 billion in cost savings, and the stock, Katie Lyons, is rallying by 6.5%.
Yeah, investors rewarding this in a huge way, John. It is so interesting to see these companies going from grow, whatever the cost, to shrink your costs as fast as you can. That kind of seems to be how the tide has shifted for corporate America. Now, for Disney in particular, as you said, $5.5 billion in cuts in total. $3 billion of that is coming from slicing their TV and movie budgets. Remember, this is a company that invested billions of dollars into streaming, trying to grow that business during the pandemic. And now Bob Iger is throttling back in a massive way, trying to focus instead on profitability and expanding those margins, because we have not seen Disney's net income keep up with the rebound they've seen in sales, which is what is evidenced by this chart here. And this really is just a case of not trying to be a growth stock like Netflix, which initially was the ambition if you look back a few years ago. And we have seen these growth-oriented companies really across the board making these kinds of changes. That's evidenced by the slew of layoff announcements we have gotten from the tech sector, trying to cut costs, capture more profit, because we know companies universally are feeling that margin squeeze. Demand is slowing down in many areas, and costs from labor and beyond still remain elevated. So we have seen that margin contraction happening in the fourth quarter results that we've been getting, about 12.1% on average for S&P 500 companies. They're expected to stay tight in the current period. And yes, there is forecasted fattening to come later on this year, John. But if you do want to expand those margins, you want that to happen, you kind of got to make some changes.
These companies just aren't being rewarded to chase growth, to chase subscribers like they were in the last couple of years. Katie, thank you. They're being rewarded to cut costs, to protect margins. Apollo's Torsten Slock had this to say earlier this week, and we caught up with Apollo's Jim Zelter and talked to him about this market environment. This is what Torsten had to say. From hard landing to a no landing, I want to explore that theme. From hard landing to a no landing, investors have been underperforming their benchmarks because they entered 23 underweight equities, expecting a slowdown that still hasn't happened. Megan, we've talked about a hard landing. You and I have gone over a soft landing a million times. What do you make of this theme, this phrase, no landing?
Yeah, so I mean, I think what he means by that is just, significant amounts of uncertainty. So as Jim alluded to, I think investors have expected a recession to come sooner than later. That was never going to happen given the huge cash cushion among households and corporates in the U.S. economy. So, I think there is a lot of uncertainty. Are we going into recession? Are we not? Have we already been in recession? This is an academic debate that mostly economists care about. I think for most regular people, whether you're or growing a little bit or contracting a little bit, it all feels the same. So, I think this idea that we would have any landing at all in the first half of this year was always wrong. We might be in recession in the second half of this year. As I said before, I think that depends entirely on the labor market and also how the Fed responds to the labor market and to inflation. It's possible it's being pushed off a bit further. There's also a scenario where different sectors of the economy go into recession at different times. So it's kind of a rolling recession. So we've already seen it in manufacturing. Maybe we're seeing it in tech. Services will eventually be hit. In a way, that's a great scenario because the overall economy doesn't go into contraction. So we don't have an overall recession, but actually inflation is brought down. So to some degree, that may be what the Fed is actually hoping for. But again, for regular people in those sectors, it's an academic debate. It's still pretty painful for them.
For everyone else trying to follow, it's enough to make your head spin. Julian Emmanuel of Evercore was on the program in the last 24 hours. He said, if you're not confused right now, you're not paying attention. Jim, are you confused?
Oh, well, yeah. I mean, this is a post-COVID economy, as I like to call it. It has different traits and it has different characteristics to anything that we haven't seen before, and the labor market is probably front and center, the most confusing of them all. The data that we see, whether we're talking about claims or payrolls or the 3.4% unemployment or even ISM employment, is confounding people because it's not showing any signs at all that the market is slowing. So that and a lot of other things about labor hoarding, as Megan talked about, that's a new concept that's mostly anecdotal and we're still trying to figure it out. Yeah, it's been very confusing because it's been so unlike anything we've seen before.
A phrase we keep going back to on this program, you can't fire what you couldn't hire. We're still trying to process the post-pandemic realities in the labor market, and then just to make everything even more confusing, China reopening. This is what Evan Brown and Luke Cower have got to say over at UBS. Evidence of economic re-acceleration from US, China and Europe is a more powerful catalyst for markets going forward. Cyclical areas of the equity market have more room to run. That's the equity call from Cower and the team over at UBS with Evan Brown. Megan, your thoughts on this too? It's not just the post-pandemic labor market realities we still need to make sense of, but also the fact China's reopening and what kind of growth impulse will we be importing from China?
Yeah, and I don't think it's just the growth impulse, it's the inflation impulse from China as well. But I would highlight that this reopening for China, this resumption of growth, it will look different than previous ones. In the past, they've been investment driven. So that's driven a lot of demand for capital goods from China's trading partners. This time around, it's consumption driven. And it's less that there's a massive stimulus and more that Chinese authorities have gotten rid of very restrictive policies. So you're not seeing a huge imbalance between supply and demand, I don't think, emerging in the Chinese economy. And again, it's consumption driven, so it will be domestic services driven. So in the past, when China's accelerated, it's really boomed for the rest of us. This time around, I don't think we'll get that kind of boom. I think China will accelerate from around 3% growth last year to over 5% growth this year. It might be mildly inflationary for the rest of us, but we won't get the growth impetus or the inflation boost from China reopening that we've had in previous Chinese booms.
Jim, final word on that.
No, I agree with that. And in fact, if you look at the commodities markets, the idea was when China reopened, they would suck up all these commodities and out the other side would come a burst of finished goods. Well, the commodities markets aren't really responding. It's been now almost 2 months, 2.5 months since the reopening was announced, and we're not seeing booming commodity prices. So as Megan was talking about, it may be more services, but we're not definitely seeing some big pull into the process of making a lot of capital goods to go out the other side. So it's very different than I think a lot of people expected just 2 months ago.
Can I just say my new favorite thing is data instead of anecdotal evidence? I just think that's brilliant. Megan, did you make that up?
No, I didn't. I wish.
I think that's brilliant. Where's that from?
I'm not sure. It's just a concept we're using a lot now.
It's yours now.
Because thank you. But it's the data's weird, and so we're having to rely on sentiment and ideas, and we don't know how to measure that stuff.
Megan, stick with us alongside Jim Bianco. Equity futures right now up 0.75%. Coming up on the program, President Biden throwing the R word out the window.
Do you think there's going to be a recession this year?
No.
That conversation up next.
everybody, welcome back to the live stream of the market open. It's currently 15 minutes till the open. We got the payrolls number. It came in worse than expected, extra 6,000 jobs lost there. So obviously yields in the dollar softened a bit, but yields really didn't drop as much as I would have anticipated. So it's kind of a nothing event. Markets are gapping up. We're going to watch for a gap and crack, the old infamous gap, and then fade it into the strength of the market. So institutions love to gap the markets up in the morning and then fade it kind of in the morning session and afternoon, and then maybe a little bit of an intraday afternoon bounce on the lighter volume. The Dixie did soften, which is why the markets actually rallied up here. You can see the DXY is down in the session substantially. You broke a key support here, basically made a new low in the trend. However, you're still holding technical support. The big levels I'm watching are, you basically hit this pivot here, bounced a little bit, which you're getting a little bounce right now, but you still have big support at 102.40 and a little bit lower. In terms of trade setups that we're watching, there is a few things on the radar today. First off, we're looking at AstraZeneca. Obviously, they reported earnings. They've gapped up in earnings. The level I have on AZN is about 70.42. 70.42 on for a short. So 70.42 is right around there. Okay, the other play we're looking at is Pepsi. Pepsi also reported earnings. Really not a high flying stock, but in terms of that level on Pepsi, where am I here? We're looking at 176 Pierce. A 176 Pierce for a short on Pepsi. We also have Microsoft. We traded this yesterday. It's gapping up again, pulling off the highs. In terms of Microsoft short level, I would look for it to pierce this level, so maybe around 270, 273.60 is actually the better level. 273.60 is the better level. So that's going to be the level on Microsoft. Then we also have Tesla on the radar. I did add to my swing short position right around this level, 208.30. In terms of a Tesla short, I'm looking at 210. A 210 Pierce. 210 Pierce. We're looking at AFRM as well. That's gap down, you know, but it's had a significant bounce off the lows. First level on there's two levels on AFRM. One of them is 1225 and 1171. So you can see them down here. And then in terms of other trades, we're also looking at Spotify. Spotify is gapping up. So basically anything above this 125.86 level or 126 Pierce, that's a great level. Disney, we are swing short Disney already. We issued an alert last night around 120.80 for our members. Now, Disney has pulled off and there is distribution occurring, but the level on Disney is going to be basically, if we retrace to this double top, around 122.40. And then this one I'm really excited for, Cirrus. It hasn't opened yet, but it likely gaps up. Basically, anything above this 107 level, Pierce of 107 and higher, we can look to potentially fade it and play the short side. So now that we have a lot of stocks on our radar, on the short side, we are looking at coin for a long, but Bitcoin's been really struggling. So this one's a little bit skeptical. There might be a little bit of a bounce play if coin flushed down to 69, but right now Bitcoin is stuck under some key resistance, so we're going to have to keep that in mind. If you look at the hourly chart on Bitcoin, it's basically trading underneath this key trend line that I'm watching, and it's bubbling and hovering along that level. So this is the level on Bitcoin that I'm watching. Right around there. But Bitcoin hasn't really moved even though the dollar has softened. So let's flip back to the S&P. We'll go back to the intraday. We have about 10 minutes to the open. The yields are trying to perk back up a little bit. You're seeing Microsoft pull off the highs. Tesla's catching a small little bid. Apple's pulling off the highs as well. Nvidia remains strong. Nvidia is another powerhouse, but remember we got these sell signals on Microsoft and Nvidia, and often you do see these retraces. Look at this big dump on Microsoft there, clear resistance up ahead. So that's certainly interesting to watch. I'm just going to flip some of my charts to the extended hours, regular trading. But right now, we're watching about 6 things. And we'll see if the markets can hold this gap up. We will see for sure. But the Nasdaq right now is up 1.2%. Russell's up 0.7%. The S&P is up 0.76%. The Dixie's down 0.75%. So the one thing that I'm skeptical right now is why gold hasn't really rallied more so even when the Dixie's down. I mean, you can see that it rallied right up to the up end of this range and it just got rejected in the near term. So that's a little concerning for gold, considering the Dixie is down quite substantially. It's down quite substantially. But there is a big resistance level in the SPY here that I'm looking at, 415.20. You can also potentially short the SPY. I don't like to chase the longs on gap ups. I've been burned in my earlier career by chasing these stocks higher. And typically on gap ups, they're often faded. So let's just be mindful of that. We did get the sell signal on Microsoft yesterday. And we'll see what type of action we get today. But obviously there's a positive sentiment moving into today with the earnings. You have AbbVie that is getting a nice little pop. Pepsi's getting a nice little pop as well. AstraZeneca's just pulled off the highs. China stocks are actually really strong today. Baba's gapped up on more AI news, but I find this very fishy because they've basically been running the same story 3 days in a row. So I'll take you through this. So basically, here's the first AI announcement. Baba announces their own ChatGPT version, gaps up, fades. Then they announced another AI movement yesterday, gaps up, fades. And now they just announced another AI potential integration of software, gap up, will we fade? That's been the trend of this AI, and notice how you really haven't been making higher highs in this initial consolidation. So I'm skeptical about these China plays. I really think this AI is hyped up more than it is at the moment, just to get a lot of retail and overzealous investors back in the market. It's an easy trigger point because it's fun, it's cool, it's hype. I do think there's a room for it in our society, and it's for sure going to be integrated, but in terms of just how quickly we are progressing, I think we're moving a little bit too ahead of steam. Water. So Apple's just pulling slightly off the highs as well in the pre-market. We're going to be opening in about 6 minutes. But Cirrus, we don't have any data. I'm assuming this one's going to gap up. But basically have your orders ready for these levels. I'll let you know if I get filled. This could be a day trade and swing trade. I mean, if you just look at this chart, you got the first distribution signal yesterday off of your double top. So it should be a pretty decent level. Let me just draw another trend line across here. And you have not confirmed above that double top, even though it looks like the price is trying to break out. And then we'll just see what other movers, once the market opens and the volume really starts to increase and uptick, we will certainly see. Let's cover natural gas really quickly, since we have a lot of natural gas bulls and lovers. So obviously we know yesterday we got hammered on natural gas. Basically, you can see that it engulfed the last almost 2 days of price action. But today we're catching a little bit of a bid, so that's a short-term positive. Intraday action on nat gas. We're actually trying to build a little base and move higher. If you close above these pivots here on an hourly close, so basically around 247, 248, if we're on an hourly close, then we can attack the next resistance, which is this 256 level. You can see it coincides with this major pivot over here. You have a wide range red bar here. So again, there could be a potential move in natural gas. Obviously inventories come out at 10, so we got to be mindful of that. But nonetheless, natural gas could have a quick pop up 3.6% if we get an hourly close above these pivots. But if we don't, then we're going to put in more bearish consolidation. So let's flip back to the S&P. We'll continue to watch things. Pre-market data here. this 415.20 level could be where the SPY pushes up and then reverses. That's kind of what I'm almost anticipating and expecting to happen. Tesla's charging near the highs here of the session, going after the pre-market pivot high around 209.05. So it is catching a small little bid on volume. S&P is catching another little bid as the Dixie softens. Spotify's pushing up into our level. So Spotify is now hitting our short level. Spotify is hitting our short level. I'm going to grab some at the open, 126.11, short Spotify. I'm tempted to grab some here, but we may have a little more upside in the S&P. Just a tiny bit more of upside. But this is the short level on Spotify. Basically, we're now trading above that 126 level. So you could grab some here. I'm going to wait till the open, and I'll let you know if I get filled, because the S&P's slowly starting to uptick. So keep Spotify on the radar, because it has hit the short level. But we may have to wait till the S&P climbs here. So we have about 3 minutes. So we have about 2 minutes to the open. Let's take a quick look at Disney. Disney's still trading off the lows. Let's take a quick peek at Tesla. Tesla's starting to push up to that pre-market high. Take a look at Apple. Apple's trying to push up. Microsoft is also pushing up. Microsoft's now into that short level. Notice how you pierce through it and you're seeing some distribution. Tesla just pulled off the highs. I'm going to grab some Spotify short here at 126.11. 126.11 spot short. It's a 1/6 position. So let me put that in. And then the next add level will be basically about 126.61, every 50 cents higher. So the spiders are about to open in about a minute. So keep Spotify on the radar. I'm going to flip back to the SPY. Notice how Tesla hit that double top resistance and there's clearly sellers lurking there. Apple remains strong. MSFT. Keep Microsoft on the radar. So the markets are just about to open in about a minute, so we have a lot of trades. We're already short Spotify slightly, 1/6 position. Tesla's pulled off nicely from the highs. We're watching Microsoft. We're watching Microsoft, Spotify, Tesla, CRUS. All right, markets are open. Markets are open. Let's see if we can get Spotify's continuing to push a little bit, so get ready to add to Spotify. Spider's seeing a little bit of weakness. Spotify's continuing. Tesla's seeing some weakness. Microsoft's coming in now. Microsoft's coming in. Spotify's starting to see some distribution. Tesla's coming in hard now. So that was a great little short level on our ad. But let's see if these markets hold this gap up. We often see big reversals. Apple's pushing up, so it's going to push the market up. MSFT seeing some distribution. Microsoft seeing some hard sell side pressure. So is Tesla. Tesla's coming down hard. So look at that dump on Tesla. Look at that bounce on Tesla. Spotify, we're just waiting on Spotify. Let's take a quick peek at Disney. Disney's coming down hard. Ooh, Tesla's dumping. We may have a long on Tesla. If Tesla comes right into this gap fill around 201.80, we will play it for a long. So keep that on the radar. It's looking like these markets want to crack lower. Let's see Spotify. So basically we're still watching. The firm's caught a bid. Spotify's reversing. We're in the money nicely. Look at this. Look at this. Boom, boom, boom. These markets could go negative. If we get some hard sell side pressure, these markets could go negative. Nvidia is strong. I'm going to grab some Nvidia short. I'm going to add to my Nvidia. Actually, I want to see it pierce that level and fill that gap. So in terms of Spotify, we're going to look for about $1 on Spotify. $1 on Spotify. It coincides with this gap fill pivot. But Spotify is starting to come in. Look at this. We're almost in the money. SPY's selling. The S&P is selling hard now. Look at this dump. So keep Spotify covering on the radar. We're almost at that level for $1. Spiders are selling. Microsoft selling. Tesla's dumping. Everything is gapping and cracking lower. So this is the tricks that market makers like to play, but it's still very early. It's very, very early. And the fact that the dollar is so down and we're seeing a big gap down, this is great. I'm covering Spotify here. 125.03. Boom. First one of the day. Awesome job. Covered Spotify. 125.03. Look at that bounce. Oof. Look at that bounce. Now if it comes back up for a retrace, we can trade it again. Nvidia's pushing up. Tesla's still seeing weakness. Let's flip back to Tesla. So wonderful job, over $1 on that Spotify. That's what we like to do. Spotify's popping back up again. Spotify is popping back up. You're seeing Disney come in hard. Msoft is seeing weakness. There's Microsoft. Disney seeing weakness. So we are short Disney. Look at that gap fill. Look at this gap and crack on. Wow. Spotify, if it hits our level again, we short it again. Tesla's starting to see a bounce. The S&P is seeing a bounce. Nvidia is remaining strong. But there's distribution occurring in this market. Google's now negative. Google is now negative. There's lots of little potentials here. BAX, Baxter International, is also flushing. Look at this gap down on Baxter, down 11%. Let's check on AFRM. Gap down but caught a nice bid off the lows. TSLA, Tesla, seeing some distribution. Let's look at the spiders. Let's look at the spiders here. Spotify is actually coming back up again. Let's keep that on the radar, but we'll keep an eye on Microsoft as well. Lots to cover here because we are seeing interesting price action, that's for sure. Interesting price action. China's seeing some strength. Pepsi's up nicely. AstraZeneca's seeing some distribution. AbbVie, the earnings plays, are seeing some distribution. Microsoft's coming in hard now. Let's see the spiders. Spiders are gapped up. I think we see a fade. There's likelihood, especially with the weakness in Microsoft. Tesla caught a huge bounce though, but more distribution is coming in. Yields in the dollar are still soft. Let's take a look at China. Alibaba is still gapped up. Affirm still remaining strong. SMH is at the highs of the session, so that's certainly a positive for SMH. Nvidia just did this double top retrace here. So you can see this is a potential short level. If we pierce this, we can short Nvidia. Spotify is still trading basically almost back at that 126 level. So let's keep that on the radar again. You know, we're almost back at that level where we could short it for another gain. Okay, so let's just keep that on the radar. Spiders are still seeing some distribution. Spiders are seeing distribution. If it pierced 126, we short Spotify again. Microsoft's still coming down. Apple's remaining strong, but coming down, putting in a potential distribution tail candle on the 10 and 20 minute chart. Spotify's still lingering. Bitcoin's catching a little bit of a pop. Let's see if we can play coin for a long with Bitcoin catching a little bit of a rally. So Coinbase here is a long. Coinbase here is a long. I'm going to go long coin at 67. Actually, no. Hold up a second. Bitcoin's popping though. Bitcoin is popping. Bitcoin's popping. Coins diverging from Bitcoin. That's really, really interesting. So I'm going to stay away from that because that's a little bit of a negative divergence. Apple's seeing some distribution. Spotify. Let's check Spotify. Spotify hit that level, but I never got filled on anything yet. Distribution on Apple. Apple's now coming down. Microsoft's coming down harder. Look at this dump on Spotify. Look at Apple come in. The gap and crack could be happening. Take a look at this Microsoft. So this is where things get really, really interesting. Yes, they do. Spiders are still seeing some distribution. Take a look at that. I'm just seeing if there's any other. Microsoft's still up 1.5%. Carvana's up, go figure, another 7%. So it seems like the safest stocks are literally the likes of Carvana these days. I just shorted CRUS. CRUS, this is a swing. I'm going to hold this overnight. This is a swing. I am holding this overnight. Look at Google getting crushed here. Google's making new lows even after it's oversold. Let's see if the spiders gap and crack. Apple's still seeing distribution. Spotify's still hanging on by a thread. We're also seeing potential. Let me check healthcare right now just to see what's transpiring there. A little bit of mixed bags in healthcare. You're starting to see Boeing show some weakness. XLK, Nvidia's coming down a little bit. The SPY's catching a small little bounce. Let me flip back to this other chart. Wow, there's a lot on the go today. There is a lot on the go. Spiders coming down. Microsoft is clearly weak. So notice how we got that sell signal and the distribution on Microsoft is happening right away. Let me see if we can short Carvana because this stock is just being a powerhouse mover. Let me see if there's any other. Bed Bath Beyond is up slightly. Google's down. Nvidia's still strong. We're seeing Canopy Growth down. AMD. So semis are actually lifting this market higher. Semis are lifting this market higher. Tesla's still seeing some weakness. Let me take a look on energy. Natural gas is still hanging on. Oil's coming down. So definitely a mixed session here. Definitely a mixed session nonetheless. Steel's weak. Spotify's still hanging on. Google's still so well off the highs. Well off. Let me see if I can isolate a level on Disney. The spiders are coming in harder now. Disney looks to be gapping and cracking. Spotify as a swing is a good level as well here, just due to how extended it is. Look at the sell on Apple. Apple's coming in. That's a nasty reversal, double reversal signal. And then you look at Tesla. Tesla's holding up really well, actually. Tesla's holding up really well. We added to our short at 208.30 in the pre-market. It says that we didn't even hit that level, so that's awesome to see. This 209 was the pre-market high. MSoft is coming in harder now. Look at Microsoft. It's starting to come in. Look at the SPY. And then we'll flip at the DX. And this is all on the back of the DXY not even rallying. Still remaining exceptionally weak. So imagine the DXY catches a bid where these markets would go. So we'll see potential day trade coming up here at 96.81. 96.81. Nvidia's pushing the highs, so massive strength in the semis. Microsoft is still seeing some distribution. Spotify's trying to push back up. So Google, if we hit this 96.85, which it looks like it's coming in. The only thing I don't like is we consolidated. So the next level, the more conservative level is 95.70. 95.70. I might wait. I might wait to play that 95.70. So I'm going to bypass this 96.81 and play the 95.70 level. And Google's kind of a little bit of a foreshadower to this market. Let's see Amazon, because that one's been disgustingly weak. It's actually gapped up, holding up fairly well. Take a look at the S&P. S&P still seeing some distribution. So now Apple's tried having a pop and it's being reversed again. Google's still coming down. I'm going to wait for that more conservative level, but it's hitting that first technical level. It'll be interesting to see if it catches a bounce at that first level or not. We'll certainly get an idea So now you're at some technical support here. Google is at technical support here. Spiders are coming down. Markets look like they're gapping and cracking. Tesla's falling. Tesla is falling. I'm going to take a look at Meta. Meta's basically slightly up on the session, but pulling off the highs. You're having the Dow components still acting very, very well. Let's take a look at likes of Caterpillar. Caterpillar's SMH is still strong. Let's take a look at coin. Coin is dumping hard, so potentially Bitcoin is going to have a hard sell. Let me see if I can isolate a level on coin here. This is a hard sell on coin. Bitcoin's starting to roll over. These markets are in trouble now. These little stocks are showing indications of exceptional weakness. So definitely look at Tesla pulling off the highs. Boom. Look at that nasty little reversal, potentially a bearish engulfing on the 5-minute. Google's getting smoked. So look at Google slicing through that first yellow support. It's approaching our first level, so this is a potential tradable level, but markets are very, very weak. This is the level on Google. I'm gonna wait because the spiders look like they're coming down more. Bitcoin's in trouble. Let's see if we can get some sell side pressure here. But this is the first. Notice how there's some buyers coming in right at that level. So we're right on the money with our level. But I'm going to wait till this 95.72 level. And then you have additional support under 95.70 at 95.08. Nvidia's coming down harder now, so it should push these markets lower, which is why I'm going to be conservative on this market. Look at this. Look at the spiders come in. The gap and crack looks to be happening. It's early on, but the spiders are coming in. Look at that. Google's piercing through that level, so it's a good thing that we're actually, Google's still holding. Google's still holding. Let's take a look at Tesla. How's Tesla holding up? Holding up relatively well. Microsoft is coming in. Microsoft, if we have a straight dump into this gap fill down here at 266.69, we will play it for a long bounce. Spiders are still seeing a little bit of a bounce here. Let's take a look at Google. Google's caught a bounce here, so we could have probably played that level. But right now, we're just going to wait because things are still acting very, very suspicious and weak. Very, very suspicious. So let's just see if we get more upside. Spiders are catching a bounce. Google's not participating, so that's relative weakness. Look at this bounce on the spiders. Microsoft is still coming down, man. It's like they're selling into these friggin' people that are buying and chasing this AI movement. Let's take a look at coin. Coin has been one of those high flyers getting demolished, down 7.2. Let's take a look at AI. AI is down 2.52%, so not as bad of a sell. Flip back to the SPY. We'll keep that on the radar. Google's trending lower now. Google is trending lower. So look at Google. You got a nice tiny bounce off that level, and likely means that we're going to slice through it now. Likely means we're going to slice through it. So right now we're seeing Spotify come in. You're seeing a lot of these stocks trying to give up most of these gains. Even the earnings plays like Pepsi have pulled off the highs substantially. You're seeing distribution in Netflix. JP Morgan's actually just almost going negative on the session. So certainly some distribution occurring in these names. Kellogg is pulling off the highs. Google's catching a little bit of a bounce here, but the spiders are still trickling lower. Coming down, Apple's coming down. Shopify has reversed. Lots and lots of potential weakness in this market. That's for sure. Wow. It's truly incredible. Google is at some support. I'm so enticed to play this level, but again, the spiders are weak. So again, if spiders are weak, you do not have the wind at your back. You have the headwind. So massive, massive weakness. Microsoft is catching a little bit of a tiny bounce. So is Apple. The buy the dippers are coming in early in the morning. The question is, can it continue? Take a look at Google. Google's catching a nice little bounce off that level now. Microsoft is catching a bounce. The Dixie's starting to perk up a little bit, a tiny little bit, so we have to be aware of that. Let's take a look at natural gas. So still just, oh, that's the wrong chart. My apologies. Natural gas is catching a little bit of a bid. Let's check this out. Semiconductor, another super extended chart. Lattice semiconductor, massive move. Let's flip back to Apple, the leader. Apple's catching a bounce. Apple is catching a bounce. Spiders are catching a bounce. Google's caught a bounce. So we could have probably traded that level, but you know what? When you're unsure and the markets are weak, you know, coming down, you want to just play a little bit more conservative. Apple's caught a massive bounce. Firm's starting to come in a little bit more now. You're seeing some weakness creep into Boeing, but the XLK and SMH is remaining very strong. XLK and SMH is remaining very strong here. Apple's had a terrific bounce as well. Microsoft's caught a little bit of a bounce. Oil's seeing some distribution, but the energy stocks are remaining strong. We'll see if we get additional weakness. Canopy growth gap down, finding some support. Spiders are remaining strong. Nvidia's also pushing back up. Nvidia's pushing back up. If Nvidia pushes back up and takes out this high, we can short it. There is a gap fill here at 230.60, which I think it would be, I think that's where the price action is likely to go. Apple's caught a nice bounce. Apple's catching a really good bounce here. So that's what's lifting the market single-handedly. So Nvidia is continuing to push up. Nvidia is continuing to push. Apple's pushing. Shopify's remaining weak. Google's had a terrific bounce off the lows. Bitcoin's seeing some distribution. Let's flip back to Disney. Disney's still way off our level. Google had that, look at that awesome bounce. That was a terrific level that we should have probably played in hindsight, but that's okay. We don't win it all the time. So you're still seeing Tesla up 3.2%. It still hasn't taken out that high. Carvana's catching a nice little bid. So Carvana's coming back up. Microsoft is concerning. Microsoft is seeing some heavy sell side pressure. Heavy sell side pressure. Let's take a look at Nvidia again. Spiders are trying to rally. Spiders are trying to rally. Interesting price action in gold. Gold's, I think, telling us a lot here. Gold is telling us a lot here. Even in this weak market environment, with the dollar being weak, gold's still getting heavily rejected off of that bear flag. So just one winner in the books for us. That's pretty much it for us so far. You know, SMH is approaching this nice little short level. I'm going to grab some SMH short here. I'm short 235.30, 253.32. 253.32. 1/6 position. So semis are remaining very strong. We will add about 50 cents higher. About 50 cents higher. Nvidia is now seeing some distribution. So we're now in the money. We are now in the money. I think we can look for at least about 75 cents to 80 cents on this trade here. So short the SMH 1/6. The spiders are starting to float back up, but we're still seeing weakness in Microsoft. Natural gas is trying to perk back up, so that's certainly positive in the short term for us. Let me take a look at Spotify again. Spotify is trying to push back up. Potentially we may have another short if it were. But the spiders are floating. SMH is floating. Apple's seeing a little bit of distribution. We're just short the SMH here. Spiders are pushing up, so the SMH is going to probably push up. There's still this technical gap on the spiders that we need to fill. We'll see if there's some weakness coming into NVIDIA. We're flat on our trade now. Spiders are still remaining strong. Pepsi's pulled off the highs. CRUS, AZN. Let's see what we can pull out of this market today. We've got one winner in the books. We've also got some weakness creeping into Enphase as well. I do believe First Solar earnings should be interesting. China stocks like BABA are still remaining very strong. Spiders are remaining strong, pushing near the highs of the session. We're flat on our SMH. But the spiders, it's good to see that the spiders are pushing up, but the SMH is not. So that's basically, it's going to be very difficult for the S&P to continue to rally if the spiders are, sorry, it's going to be, difficult for the S&P to rally if the SMH and semis are showing a little bit of weakness. But you are starting to see Apple push up now with the market. So Apple should lift things. Apple should start to lift the market. Semis were now in the money. Let's take a look at Meta. How's Meta doing on my other screen? Meta's still positive. The Dow's still up. Likes of McDonald's are showing a little bit of strength. VIX is down. VIX is down. Apple's starting to see a little bit of strength. Semis are perking back up again. But seeing some distribution definitely occurring. Distribution is definitely occurring. Semis are now coming in. NVIDIA is starting to see some sell side pressure. NVIDIA is coming down. So notice how that's correlated with NVIDIA. Spiders are now seeing a little bit of distribution as well. Look at this. So we failed to make out a high here. Look at the markets coming in a little bit harder now. And that's not even on anything. So get ready to cover the SMH here. Get ready to cover the SMH. The level to cover is basically 252.51. BAX is interesting as well to swing trade. Baxter International, that's a big gap down. Even if you put it on a weekly chart, it's had a massive gap. You're into this huge support range. Look at this pivot that we just hit today from 2008. I mean, that's a very intriguing chart. Look at this level of support. This is huge. Huge, huge support. SMH is still coming in. It's hitting our level now. So we are in the money. Oh no, never mind. Sorry. But Baxter's an interesting chart. Apple's big sell on Apple. Here comes the markets. Here come the markets. Apple just made a new low. Tesla's holding up well. Microsoft's holding up. Google's still coming down. So this is going to weigh on the markets here. This is going to weigh on the market. Big sell on the spiders. Here we go on our SMH. We're almost in the money. Let's go, let's go, let's go. We're hitting our levels. If spiders take out the low, which it's testing right around now, around 413.23, but it's likely we're going to take out the low. Why? Because Apple just made a new low. Tesla's holding up really well though, so that's a short-term positive for Tesla. Keep SMH. I'm keeping a track of NVIDIA as well. China's starting to see some weakness creep in now. Let's take a look at Affirm. Affirm's still hovering off our level. Boeing's seeing a big sell. SMH is coming in. Spiders are seeing a little bit of distribution. I still think we could see this market gap and crack. Where it's gapped up. There's still a gap fill up here which it could want to fill, but again, a lot of bulls look at that and want that level. So let's keep an eye on SMH. Apple's still remaining weak. Shopify is coming down harder now. How's our natural gas doing? It's still slightly positive. Oil's basically slightly negative on the session. Down about 1.2%. Google's testing new lows. So Google's a heavyweight that's weighing in on this market recently. Like, look at this. Just can't sustain any meaningful bounce. It's really, really incredible to watch. It definitely is something to behold. So we're still watching the semis. I'm watching the spiders. The Dixie hasn't moved. The Dixie has not moved yet. Affirm's down 15. Tesla's up 3.2. BBBY is up. Disney's up 4.2, pulling off significantly from the post-market highs on earnings. AI's down, Amazon's up slightly by 1%, Nvidia's still up 2%, Carvana's up 1.6, Apple's up 0.8. Markets are catching a bounce here. Tesla's actually pushing up, remaining relatively strong. Tesla's making a good push here. Take a look at Shopify. Let's take a look at Coin, because Coin was having that hard sell. Notice how Coin got a bounce. SMH is pushing back up. Apple's catching a huge bid here. The Dow is still remaining strong, so as long as the Dow is strong. Meta's starting to see some weakness. Meta's still positive. So Tesla's trying to push for that pre-market high. We'll see if it can actually do it. Let's flip back to the S&P. S&P is still catching a bounce. We'll keep the SMH on the radar. I still think we're going to get at least this 80 cents out of the SMH, but it's only a 1/6 position. But the markets are still seeing buy the dip mentality. Another important stock, JP Morgan, just went negative in a strong market, so it's very rare to see the big banks, big boys, going negative in this market. This is a leading indicator. JP Morgan rarely goes negative in a strong market, and when the markets are up over, we're talking about a gap up on the S&P that's made us up 0.76, tech's up 1.18. To see JPM, just be cautious. Just be very cautious about this rally and buy the dip, because JPM not participating in a strong market is a red flag. So we're also watching Baba's coming in now. Baidu's coming in, making potentially new lows. Let's see Walmart and Costco. Walmart's up, Costco's up, so consumer staples are getting a little bit of a bid here. Spiders are coming in now. The dollar's actually starting to perk up a bit. So this is interesting now, because the dollar's trying to take out this high. If it closes above this, the next pivot we attack is this zone, 102.80, and the markets will see downside, just like it is right now. So only one winner in the book so far. Spiders new lows. Oh my goodness. Here we go. And that Cirrus short is working out well. Yes, it is. Google's testing new lows. Tesla's still a powerhouse. Tesla's a beast of a stock. Tesla bulls, you should be proud. You're holding it up 3.59%. Massive move. But be careful. Just be careful. Be very careful. SMH, Disney is making new lows. Look at this fade on Disney. Oh my goodness. We're going to be in about 10% in the money by the close here on Disney. Let's flip back to the SMH. Nvidia is still remaining strong. Dollars yields are starting to perk up. Looking at healthcare as well, we're seeing a little bit of distribution creeping in. Boeing is starting to roll over. Boeing's a leader. Look at this collapse on Boeing in a strong market. The leading stocks definitely tell you a grand picture. It means smart money is getting the hell out of this and not believing this market rally. That's for sure. At least today, that's what smart money is saying. Tesla just briefly made a new high. Apple's catching a bid. Market's still remaining relatively strong. It is. But semis are getting a nice little push again. Semis are getting a push. We'll see if the market still can fade. There's still lots of time. Microsoft's now seeing the next sell side pressure come in. Take a look at Microsoft. Boom, little bounce. Apple's coming in. So the downside about what just happened on the S&P is, I'll flip to the SPY. The SPY actually made a new low on this candle. So the fact that you couldn't hold this and you made a new low, you haven't closed below it, but you did wick through it, tells me that there's still likely weakness going to creep in. So let's just see what's transpiring here. Nvidia's starting to see some additional weakness, so that's going to help our SMH. That should help our SMH. We're in the money still on our SMH. Google's testing the new lows. There's still a potential long on Google, but we have to be mindful that Google had a big bounce here. And let me just isolate down the next levels. So 94, 96. We still have natural gas inventories coming out in about 30 minutes. So we'll watch for that. Let's flip back to the semis. Nvidia's catching a little bid. Spiders are catching a little bid. China stocks, Baidu's selling a little bit harder now. Canopy Growth's acting very weak on the session. Let me take a look at gold. Gold's very telling because gold is still in that bearish consolidation range. Let's take a look at miners, GDX, gapped up and fade. Take a look at the SPY. SPY's catching a little bit of a bounce. It certainly is, but this gap remains there's two gaps, so it could go either way right now. You're trading in no man's land right in the middle, but I'm seeing definitely some sell side pressure occurring in these markets. And like I said, with those leading stocks making new lows on Google, look at this, look at that. There's buyers here. You could play this for a potential bounce here and use this as a stop out, but again, with the markets trading in no man's land on this gap up, I don't trust it. I certainly don't trust it. Look at Apple coming in, SMH, Tesla still remaining strong. Tesla's still seeing a little bit of distribution, but pierced that pre-market high. Short-term positive for Tesla.